it seems to take a little while when we go live here. So, which I think we're live now. But
Looks like
all
it.
right, what's going on? What's up? I'm Russ. This is Dapper Dividend's YouTube channel here with my guy RyneWilliams. What's
What's
going on
going
by
on?
you out there? Where you're over in Sacramento, Sacktown? What do they call it? What's the nickname for Sacramento?
Man, it was the city of trees, and it might still be, but I know there was some talk of it becoming the farm to Fort Capital of America. So somewhere in there, that's what we call it.
Nice. So yeah, I'm here in the Windy City, well, on the outskirts of the Windy City.
Hmm.
So yeah, man, I wanted to have Ryne on. We're going to talk about Intel a little bit. Interesting dividend stock right now that I know a lot of people are hating on, and probably for good reason. So just to kick it off, my opinion has changed just a little bit. I'm not as bullish on Intel, and this kind of points out how, man, we make statements, we like things, but we don't have future information. So, it's always remember that for everyone watching at that moment, always take YouTubers or anybody, any analysts, take their opinions with a grain of salt right at that moment, because as the facts change, your opinions most certainly should and can do change, right?
Yeah. Adding to that real quick too, like just because you see us buying certain stocks or us talking about certain stocks we bought does not mean you should go out and do the same thing. Not at least without further evaluation, right?
Oh, 100%, 100%. So, just I'm going to kick it off. Kind of the overarching thing that I'm seeing that's interesting is, for those of you that don't know, Pat Gelsinger is now the CEO, and he used to be the CTO, the Chief Technical Officer, from '01 to '09, and then he left to be the CEO of VMware. And the previous CEO, Bob Swan, was the CFO of Intel. He was the chief financial officer. And I think it kind of shows that he has just a different mindset and a different philosophy about where the company should go as a former CFO, only looking at the numbers. And Pat, he's got a good vision, I think, and he really wants to take this company in a new direction, because it's pretty clear they've lost market share. They're not the behemoth that they used to be with virtually no competition. But to kick it off, so far, this quarter two was pretty bad. They got punished hard. Their stock price got beaten down. They had revenue of $15.3 billion, which was 15% below their original quarter two guidance. So that was nasty. Their earnings per share of 29 cents was 41 cents below their original guide. Their CapEx spending was $7.2 billion, which at the end of this, I've got a really interesting thing to say about research and development, which is part of just their overall spending. Their adjusted free cash flow, and this is where they got hit hard, was negative $6.4 billion. And that's been the first time in forever that they've had negative free cash flow from what I saw. Their balance sheet, though, they say is strong. They pointed out they had $27.5 billion of cash and investments, and they gave a full year guide of $65 to $68 billion, which is about 10% down from their original guide of $76 billion. So that's where we'll start it off, that they're clearly behind the eight ball and hurting a little bit. I mean, do you agree so far?
Yeah. One of the things I do remember reading, maybe in news or in the report, was that they were expecting more free cash flow to come in kind of later in the year. This might be, I guess, one of the slower quarters for them. And correct me if I'm wrong too, but I think they are still forecasting positive free cash flow for the entire year, right? Yep. And kind of right now, obviously, it was not the most desirable quarter. And I know, when we've kind of talked about this company briefly, just in text or whatever, where I don't think we should completely write it off or completely judge it just based on this one bad quarter. It's definitely insult to injury over the last however many years as they've been losing that market share. But they're in the middle of a turnaround right now, then a little pivot, and that's definitely requiring some capital. So maybe it's not too surprising in some capacity that we're seeing this come out this way, right?
Yeah, absolutely. So I got a bunch. I was telling Ryne before we started, I got a bunch of bullet points here that maybe I will just, I'm going to read them. And if you see something that you want to talk about, just cut me off, and then we can chat about it a little bit. So A lot of this they attribute to the PC, total addressable market, or if you see the word TAM used, it's shrinking 10% year over year. And their customer inventory is also declining, which is affecting Intel. They say the sudden and rapid decline was from economic activity, the downturn, obviously, that we've been seeing. I found this interesting. Pat Gelsinger noted that since he took over as CEO, they've exited 6 businesses. One of them was their drone business, and that's given them an extra $1.5 billion for investments. They also do want to be, as we know, a leading geo-diversified systems foundry company. They want to be making chips for everybody. They want to make more chips than PepsiCo. I just thought of. I was going to say, I always say that, but I've never said that. People won't get my sense of humor. Yeah. Pun intended, I guess. There we go. They have business with, I wore it because, I got to move, Lockheed. I'm watching myself in reverse here. So, yeah, they have business with Lockheed Martin on 5G. They also have business accounts with Meta, AWS, Amazon Web Services, right? Web Services, I think is the W. NVIDIA, Cisco, and out here in the Chicagoland area, the Argonne National Laboratory in Aurora. So I thought that was pretty cool. Just to name some of the big ones, they kind of listed a lot of others. Pat pointed out they have 10 plus revenue producing product lines that are going to be coming out this year and more next year. So they're really kind of trying to exit the businesses that they don't think are going to be doing well for them and then introducing the new ones. They didn't assume any of the CHIPS Act, which is about to pass. I don't think Biden signed it yet. I know it passed the Senate, and I think it was going to the House. Although that sounds...
I think it passed the House too. I think they're just waiting for the signature from the president.
Yeah, and you'd think that's... Well, because I was going to say, it goes from the... Don't they originate in the House? All bills, I think, of spending originate in the House. They control the purse strings, and then it goes to the Senate. But then I think they can kick it back to the House. I forget the intricacies. If anybody knows, you can let us know. But it's something like that. I should be better off, in civics, I guess. But so they assume none of the CHIPS Act money for 2022. The data center growth Intel's data center growth was slower than the overall data center market, which is one of their sore spots, as we will see. Sapphire Rapids was delayed. So Sapphire Rapids, as I understand it, is like their data center processing. It's like the latest and greatest. I think it's built on Intel. I'm going to get in trouble here. 7 or 4? I think it's 7. I got a lot of numbers going on in my head, people. So somebody please correct me. I know somebody out there knows.
I think 4 is the newer one.
Right. And then I did see something
have that
about
wrong.
I did see something about 7. So either way, the point is it's the latest and greatest thing that a lot of investors and businesses were banking on is Sapphire Rapids, and that's been delayed, and it looks like it's just pushed back toward the end of the year, which, let me stop there. That I think is a really negative thing because AMD is taking market share. They had their earnings and they're kind of getting hit a little bit hard too, but it's clear that AMD is taking market share. And as my guy, the European Dividend Growth Investor says, they're eating their lunch. And, oh, by the way, he's going to be on with me next Saturday. I got him to come on live. So as long as the stars stay aligned, we're going to be chatting. So that should be fun. But it is delayed, and this was a big one. This was a big sore spot. So the way I'm looking at it is because technology evolves so rapidly that people are starting to think that by the time they get it out, that it's going to already be so far behind some of AMD's technology and like the next evolution, the next step, that it's almost going to be like too late. But NVIDIA chose Sapphire Rapids over AMD's EPYC or EPIC. So that's interesting. Hopefully that's going to help level things out. And this is what we're betting on. We're betting on that Sapphire Rapids is going to really ramp up into the end of the year and start bringing in a lot more revenue. So it's kind of a holding pattern. And that's one of the reasons why I think a lot of investors just said, you know what, we're out, not going to wait around for this. And they got punished. And I think rightfully so. Rightfully so. It was supposed to have already been out and making money for them by now. A couple more things. Mobileye was a bright spot. and they have a backlog on Mobileye. So Mobileye, do you know about Mobileye, the autonomous segment, the AI, the automobile driving, which I think is amazing. That is, that's coming. I was just talking to somebody that's older than me saying, I'll bet you if not my grandkids, my great grandkids will think it's completely strange and bonkers that we used to drive our cars, that we used to get behind the wheel and actually put hands on and drive. And, I'm looking forward to it. I mean, what do you think about the autonomous driving? Is that something you're looking forward to?
Yeah, I mean, I look forward to being able to just kind of kick back, and I'm more of a passenger anyway. I'd rather ride than drive, so I'm on board with it. But in that regard, but then again, some people in the live chat might even bring this up. It does raise a little concerns just because it's so, it's a little bit foreign to us at this point. But I guess losing that control could be concerning to, some riders, right?
Yeah, but I think they said they've got 1.5 million vehicles that they're kind of mapping out. And I think they said they have 90% of all US and European roads mapped out. And obviously this is all going to tie into like the network coverage, so we can have constant GPS coverage from coast to coast and border to border, I would guess. And I think it's going to be great because, dude, I drive around a lot for my work, and I notice so many people on their phone and driving with one hand. And I think a lot of accidents will be eliminated, a lot of distracted driving. They'll see better at night. A lot of people have issues driving at night. So it's going to be evolving, and I think it's still in its infancy. So that's kind of interesting. That's something I love. But overall, they said Q2 and Q3, they expect to be the financial bottom, and we're going to start to see strength and recovery in Q4. Going forward. And they also said this is probably because, or not probably, I'm saying probably, they said it's because pricing takes effect in Q4, and they're going to have a strong presence in the PC space. So that to me is a little bit concerning because they also said the PC space is shrinking. But hey, they know the business better than we do, and all we can do is go on what they're telling us. They're also doing this by aggressively investing and committing to strong and growing dividends, which is what I always look for. I know it sounds quirky, but I love to see when companies at least say that they're serious about the dividend and they're committed to growing that dividend, which they did. And that's kind of wrapping it up. But what I wanted to end with, and this is something that I learned from reading one of the books that is fantastic. It's called Warren Buffett and the Interpretation of Financial Statements. Fantastic. One of the things that Warren points out and looks for is looking at companies, their R&D spend. So I compared and contrasted with PepsiCo. So get this. Intel in the trailing 12 months spent $16.6 billion on research and development. That was 70% of their operating expense. And when you look at that as a percent of their gross profit, it was 45%. So the way I look at that is out of every $1 of gross profit coming in, they're spending 45 cents on R&D, which is way up there because PepsiCo spent $752 million on R&D, which was 2.3% of their operating expense. And of gross profit, that was 1.7%. So they're spending 1.7 cents on R&D for every dollar of gross profit that comes in, because what more R&D do you need to spend on Frito-Lays or Doritos or just
products
classic
that never change?
And this is part of what I wanted to lead into with you to see if you kind of feel the same way, that investing in a company like Intel or AMD or any tech company that has really high R&D spend shows that it's a highly competitive market, and they have to constantly be innovating their products to stay competitive and keep making money. And if you have a delay, like with Sapphire Rapids, the other competitors start taking more and more market share really, really rapidly. And this is why I don't want to have as much Intel as I do. I still think it's a great turnaround play, but I think if we're looking at a risk needle, like earlier in the year, I thought it was lower risk, but I think the risk needle just ticked up, and I'm trying to exit the 100 shares that I do have. I got stuck with them. For those of you that follow along and play along at home, I sold a cash secured put at $47 a share because it had found a lot of support right around there, and then it just started dropping along with the tech space and just in general weakness on the market. So I'm trying to get out at the low 40s. I've already received a few dividend cycles. I've already received some covered call premiums. So if I can get around, $42, $43 a share, it'd be, a few $100 loss. And I could use that as a tax loss harvest to claim against, my income for the rest of the year. So that's kind of my overall thought with Intel, is that I am a lot less bullish. And as a side point, this highlights why it can be so risky investing in some tech companies. So what say you, Mr. Williams, as I drink from my Flamingo cup, which I'm whitewashed again. I got to correct this lighting here, but sorry.
Yeah, I would agree with pretty much all of that. It does seem, number one, that the sentiment's changed around the company after this recent earnings report. And maybe, if they have a couple more quarters like this, the risk will continue to increase. And I think as investors, we're hoping this was just a one-off thing. But we'll see if what they said in the report holds true when we see the full year earnings report, see how their cash flow ends up at the end of the year. But personally, and kind of like you said too, I'm not looking to have too big of an allocation of this stock in my portfolio. Right now, it's just under, I actually just bought some on Friday. It's just under 5% of my total portfolio, and I'm pretty comfortable with where that's at. And I think your average cost per share is a little bit lower than mine, so you're at a little bit less of a loss on it than I am right now. But I'm touching 30%, and it's definitely tempting to continue averaging down on it. But I think I'll just be chilling and put that money into other things for now and see how this plays out. I know personally, you got a couple decades on me, Russ, but I think just because I'm younger, I can take on more of this risk and can afford to see how this plays out. Especially, I only have 50 shares. I've got, even if it went to zero, it's $1,700, which in the grand scheme of things, for me, it's not gonna completely break me. So I feel pretty content with where I'm at in this position.
Yeah, same. I'm not adding any more. I'm holding, and like I said, I have that 100, but I kind of look at those as like a placeholder, for selling options. This is part of what can happen when you sell options and you get stuck with something. But I was okay going ahead and thinking I was going to be stuck with this. But real quick, before we get to the Q&A, let's I want to pop on the Simply Safe Dividends chart here.
Yeah.
For Intel.
Yeah, I'd be curious to see if that's changed at all from prior to the report till now.
Yeah. So are you seeing Intel right now?
Yeah. The dividend safety score still looks pretty high.
Yeah, I meant to put this on my phone. I'm a paranoid, people. I like to, this is a couple of people said they love my fumbling and bumbling when I do stuff like this. So I like to make sure it's there. I always have my phone next to me on mute, but here we go. So yeah, they have an 80 dividend safety score of 80. That yield is super, super high right now. Into mine. So across two portfolios, I have a total of, 126 shares. And that's an average cost of $47.46 per share. But a lot of those are 100 at 47. So I'd like to move on from those eventually. And it's 3.5% of the portfolio in total. So it's not ideal, but yeah. And actually into Simply Safe Dividends just reaffirmed their safety score on July 29th. So a week ago, something like that. But I want to point out a couple reasons why they're getting beaten down so bad. We see that is that too small? Maybe I should, can you see that all right, I think? On the screen.
You could probably stand to zoom in a little bit.
Yeah, let me do this. So just 1 second, everybody. I'm going to take us off of here and do this. There we go. Yeah, so you don't need to see us looking at this along with you. All right, so there we go. And they've had 23 years of uninterrupted dividends. They've grown the dividend for 7 years. They do increase it overall pretty quickly, 15% 20-year CAGR, but the latest one was only 5%. Well, I say only. That's not terrible. Let's see. They just went ex-dividend a few days ago, and they're going to pay 36.5 cents per share. But that dividend yield is 64% above their 5-year average, so sky high. But the PE currently is 15.3. And remember, their earnings are in the toilet. So that's why that pretty much spiked like that. And it's if you want to pay 15 times earnings for a company that is in decline right now. Their free cash flow payout ratio, again, earnings payout ratio can be manipulated. The earnings per share can be manipulated a bit, but their free cash flow payout ratio, which is important, is currently negative 367% because they have negative free cash flow right now. And just across the board, earnings per share dropping, free cash flow per share dropping, earnings per share growth dropping, sales growth dropping, just everything is dropping, including sales. The last 12 months, they've increased shares, 0.5% from 4.09 billion to 4.11 billion. It's just same across the board. Their return on equity has been declining since 2018. Granted, this is also when Bob Swan was CEO, so that's mixed into a lot of this too. So I look at it as Gelsinger trying to turn the ship around. Return on invested capital just dropping, everything. So it's a company in decline right now. Operating margin, free cash flow margin, although that did pop just a little bit the last 12 months. And their net debt has at least been declining. It's at 9%. And I love the interest coverage ratio. Although it's been dropping, they have $25.06 of operating income to cover every $1 of interest expense. So with that being said, I see them as a company in decline. Clearly, they're in decline, and Gelsinger is trying to turn this ship around. So we've been going on 21 minutes. And if you don't have any last words to say on Intel, I want to get to some of our comments here. We'll blow through them if I can.
Yeah, I mean, just quick closing thoughts to kind of add to your point there. It definitely seems to be a company that's in the middle of a turnaround, right? And so if you're buying into it today, which the price on it today does look really good, definitely compared to where it has been. And if you're buying into it today, you're buying into it with the realization that there is more risk right now compared to where there used to be, which is why we're seeing, I guess, the lower share price and the higher yield, more risk there. So I guess if one is going to buy into this company today, which I'm seeing some chat about it in the live chat right now, definitely go into it with that realization, and it might be a few years before things really come to fruition. Especially for a company as big as Intel, it's not like turning a speedboat around. It's more like turning a pirate ship around. You got to adjust the sails and let the wind do its thing. So yeah, I guess we'll see what happens in the next few years. But I'm going to hold on to it until then, because just let's see what happens.
Yeah, just build off that. Is just know that there's risk, that it's a risky play, but I think they're going to eventually right the ship and get things under control. But again, we're going to see there's going to be some weakness, they still think, for Q3. So remember, the market is always forward looking. It's not where you've been, it's where you're going. And the market clearly doesn't like the direction that Intel is going. So I think we're going to have to really pay attention to the Q4 earnings and see if they indeed are starting to turn around in Q4. So with that being said,
can I add one more thing too? It is also important to note that it's probably not the best strategy to fill your portfolio with companies like this who are in the middle of a turnaround. Albeit they're cheap, it probably wouldn't be best to build your portfolio around companies like with this as the basis, or we could use AT&T as another example, maybe potentially Citigroup as another example, all very cheap right now, but all seemingly in the middle of some sort of turnaround. And so, when considering these investments, maybe cross-reference that with your other investments. You already have a good base of secure, profitable, sleep well at night stocks like the Procter & Gamble's, the Pepsi's, the Microsofts and Apple's. Is that more the base of your portfolio? Maybe consider those before adding into something like this.
Yeah, because I would be super, super surprised to see like a Pepsi, Coke, Procter & Gamble, something like that, to see them struggling to turn around like this or having to do a turnaround. So, but again, there's a lot of upside, but there's a lot of risk, and it's down for a reason, and with good reason. So,
and in the meantime, the dividend is still intact. So,
and they say they're committed to it, right? They say they're committed to it. They have $27 billion of cash. So I think, but they're going to be eating into that. It'd be like your finances. Right. I mean, they're going to be eating into that while they're trying to turn it around. So
yeah, you're tapping into that rainy day fund. Yeah.
Yep. So, hey, good morning. I got Steve Bishop. Hey, Cookie Monster's in the house. What's up? Hopefully still here. I know I'm not going to read all these. Hello to Kamaray. Shamir's in. Let's see, Jack Murphy, old Jack Murphy Stadium, where the Padres used to play, I think, right? The Murph. Anybody? I just bought some. So some good news. Well, this is probably right when you tuned in. So we're going back here to 11 a.m. But let's see.
Time will tell,
Yeah.
Jack. Time will tell.
Camaray says he thinks they're going to have a few more rough quarters. Yeah, and Intel thinks that as well. And yeah, Camaray again. Yeah, he thinks it could be if you're waiting a few years. Ryne touched to that. Let's see. What mug is that? I didn't see. Shamir says he has a funny mug.
This is a birthday present for me recently. So it's my new favorite mug.
I love it. Was that in one of your recent thumbnails?
I don't know. I don't think so. I don't think it was actually in one of my thumbnails. It's just kind of been my go-to mug for, pretty much ever since I got it. So it's always close by.
I love that. I love that. A lot more hellos. Hello to everybody. Yeah, AM again with camera. AMD's be like a drum and data center chips. Yeah.
Hey,
100%.
Russ, ex-Dividend dad, who is a former, he was in the Navy, I guess, as well. He wanted me to tell you hello. He couldn't be on the stream this morning, but he wanted me to say what's up to you for him.
Oh, nice. Well, salute you, brother. Fellow Squid, I'd love to know what you did, what your rate was. That's a funny thing. People will ask me what my MO was because a lot of people that weren't in don't know. And I'll say, didn't have an MO because that's Army and Marines, I think. So we had rates and I was a machinist mate. That was my rating. And then rank is like, I was a petty officer 3rd class when I got out. But anyway, that's too esoteric. Yeah, this is pretty good. Yeah, Chip is just the bill on Capitol Hill. For now, it's going to become law. Yeah, waiting to become law.
Good rhyme.
Yeah, I like that. I might steal that.
Am I a backseat driver? I don't know. Depends who you ask, I suppose.
Let's see. Yeah, he loves driving. So some people do love driving. I love driving at 70 miles an hour on the expressway and open roads. But when I'm sitting sometimes here in Chicago, I will go. It'll take me 45 minutes to go a mile. Stuff like that. That's stuff.
And it's not like that will go away. Like it's not like you couldn't ever drive again with autonomous driving.
I like it, Steve. Yeah, I actually mentioned this robo trucking. Yeah, that's definitely coming. And especially when they have batteries, they're going to go as long as they can. They don't have to worry about sleeping. They're not going to be distracted. You don't have to worry about the AI falling asleep. It's yeah, good point. Cookie Monster, autonomous driving helpful for new drivers with kids, elderly. Yeah, it's going to work its way into society. It's slowly going to work its way in. And again, see, right there's a point. Like Intel has Mobileye, and maybe Mobileye will be one of the top technologies to help buoy that company.
Yeah, it'll be nice to be able to eat my In-N-Out burger on the way home.
I like this comment
with both
from Nick.
hands.
I love that. I like this comment, Nick. Yeah, it's great. So what he's talking about, it reminds me of trading that I remember learning. If you're trying to do a swing trade, when a stock is just falling and falling and falling, that's called the falling knife. And they say to wait for it to hit the floor and rattle around on the floor a little bit and start going up before you invest back in, because man, you try and catch that falling knife, you get cut. You don't know where the bottom is. So I think that's pretty good. Smart money is probably waiting to see Intel put a bottom in, and yeah, not trying to pick the exact bottom. So beautiful point, Nick. I love it. Yeah, let's see. Yeah, some autonomous driving chat. I guess everyone can see the chat too, so I don't need to pop on everything. Here we go. Yeah, he says could see Intel dropping the mid-20s. That would be tough for me with an average of $47. That would probably hurt. And I love my stocks. I get married to them, unfortunately, which is why I'm a great dividend investor. So I'd probably just still hold and, let's see. Yeah, Cookie Monster doesn't see it going below 30. I like it. I hope so. There we go. I love my guy, Journeyman. Intel's a value trap, but it will continue to hold. Or he's going to continue to hold. Yeah, I think I'm going to do the same. And you could be very, very right. As Simply Safe dividends become more bearish on Intel. No, they just kind of reiterated what we talked about, that they've become a lot more risky. And for now, it looks okay. But things change, situations change. And yeah, we just got to be aware of that. So as long as we're aware, then that's good. Some of that PEP R&D money is going toward developing pizza with anchovy flavored Lay's chips. Do you know what? That's funny. We joke. I know it's a joke, but it's so true. I used to work as a subcontractor at a company here, and what they did was they would make flavorings for potato chips, and it was the most bizarre thing because they would say that it's all about the chemical reaction on your taste buds. So they like manipulate your brain based on the chemicals that are touching your tongue. So they put a lot of money into figuring out how to make something pizza flavored, but it's apparently not pizza flavored. It's just your brain thinks it's pizza flavored when it senses those chemicals. Wild stuff. And that is indeed what some of that money goes into. So now you're all aware of flavoring chemicals in your brain and how it affects that. What else do we got? Yeah. Oh, yeah. You're right. They did have a Simply Safe dividend score of 80, so they still think it's safe right now. Nice. With 100 shares. Cookie Monster, are you selling options? Are you selling covered calls like I am? I was just able to do one for $43 before earnings came out, so I got a little bit lucky there. But overall, it's been All right. And on, he says Intel's a hold. Thesis still the same. Turnaround play expects it to be at least 5 years. Hey, man, 5 years? Wouldn't be surprising at me, or I wouldn't be surprised. Journeyman's $44.
Not bad.
Yeah, that's better than me. I'm at 47. Gonna start a position DLC. What's up, buddy? And the current price and the government noting the storage of chips, it could be solid going forward. Yeah, I think. And actually, I'm thinking that when the chips money starts to funnel in, because they're building a foundry in Ohio and one in Arizona, that hopefully people will start to bid that share price up. And I might use that as the position to just sell an aggressive covered call and exit. But yeah, I think they're going to have some strength, hopefully, and they should turn around. Alexander Kim, Intel is a value trap. Can't argue with that. I assume Nick here is talking about what I was showing with everything just declining. And yeah, it is yikes. That's the proper response. Turn around with time, says Joe Schneider. Large company Intel need time to fix itself. IBM. Yeah, IBM. Do you invest in IBM? I sold them because of some of the hijinks with their financial engineering. And I got out of IBM.
No, I don't have any in my portfolio. I was considering it for a brief amount of time, but then I looked at the financials and decided it wasn't for me.
Yeah, I wish I could remember the specifics, and I did a video on why I exited them. That, man, it looked like the dividend was being financed through debt, I think is what it was. But they have a really great, again, my guy, European dividend growth investor, I could probably get into it with him, but man, he talks about them just completely manipulating, like they have adjusted free cash flow numbers, which I did see Intel had adjusted free cash flow. So that kind of makes me a little bit, you can call anything adjusted. It's completely subjective to whatever the company wants to call it. Adjusted, and that falls under the non-GAAP, the non-generally accepted accounting principles. So that can be anything they want, I think. What do we got here? Yeah, if anybody wants me to look up something on Simply Safe dividends, or you got a question for Ryne or me, let us know. Why not invest in MU? That's Micron. Yeah, I've never really looked in Micron. I've seen them bandied about, and I've seen them around. Do you know anything about Micron, Ryne?
I don't.
Yeah, I'm just punching them in right here.
What do you think about Broadcom, Russ?
Oh, AVGO. Yeah, they're solid. I think I'd like to have a position in them. So I was just looking here. Here, I'll pop on Micron real quick here. Yeah, Broadcom, I've never dug into them too much, but from everything I've seen, I think they looked pretty good.
Yeah.
And we're not on here. Okay, just want to make sure. Yeah, so Micron, okay, here. This is kind of turns me off. They have a dividend yield of 0.74%, which is way above their 5-year average. So it's basically, I don't know what to call that, microscopic. So they're paying 46 cents a share per quarter. And they have been growing it for See, now this is weird. Does anyone know? Did Micron just start paying a dividend? Because this shows really nothing until July of 2022. They had a 15% increase. And then let me just look at this. Yeah, their dividend yield is 227% above their 5-year average, but the PE is also way above their 5-year average. So, yeah, they must have just started paying a dividend because this shows nothing before 2021, but only 10%. Yeah, I don't know. I think I'm done looking. It's too small for me. I mean, not even, 1% dividend. And I understand they grow it, but I at least need something, I don't know, at least over 1.5% with a lot of growth like Lowe's is, right? Like I think Lowe's is a good example of a company that doesn't have a really high dividend, but they're growing it really, really quickly.
Mm-hmm. Yeah, the dividend growth rate on Lowe's, I think, is getting close to 20%, right? It's up in near 18 and the upper teens.
Yeah, trying to do this slick here.
Hey, what are you into any real estate investment trusts at all? Do you have
Oh, yeah.
many of those in your portfolio?
I do. Here, I'll tell you, Lowe's is 20-year CAGR of 24%, a
Oh,
5-year
okay.
CAGR of 18%, and their last increase was 31% in May of 2022. So Lowe's is that's why I started investing in them in the Roth, and I'd really like to build out at least 10 shares of them. Build out, pun intended, I guess. But REITs, as far as REITs, I do have REITs. I could probably pull it up here. So let me talk while I'm doing this. Why do you ask about the REITs? Are you something you're thinking about or looking up or?
Yeah, well, I just found this one the other day. It's kind of like a small cap REIT. Market cap's maybe like just under 10 billion. But I think it'd be interesting to look up. It's KRC, Kilroy Realty Corporation.
Okay.
But yeah, I definitely think it's worth a look. Even if you just go through like their income statement real quick. A lot of growth coming from that company,
Okay.
and pretty
All
nice
right.
dividend stats too.
So here's the real estate that I have in the portfolios I share. And I always tell people this is not like our whole thing. I have a 401k with my work, and obviously that's just mutual funds. I'm not going to share that. So this number on the board. This is what I've started building out since I started the channel in 2020. And the self-directed IRA, luckily, or I say luckily, right before the crash, I pulled out 30 grand and I did it wasn't taxable because it went from one IRA to the other, but it was sorted by portfolio percent. So yeah, I have OHI, Omega Healthcare Investors. They have an unsafe dividend score. It's 8.3%. I wouldn't be surprised if they cut. And I do have a covered call out there on them. Simon Property Group, IIPR. I've talked about them. They're the cannabis grower landlord. Store Capital, Warren Buffett and I both invest in Store Capital. Stag, industrial. So they have a lot of real estate in industrial. Like that's kind of what I do. Sorry, I know you guys can't see us. Vici Properties, which I love. I'd like to have more Vici Properties, and ONL. ONL, I'd like to get out of that. That's the spinoff that Realty Income shat out that I did not get rid of. I held on to them too long. But I'm sorry. Let me go back to this. You wanted what was it? KRC?
Yeah, check out KRC real quick. I'd be
All
curious
right,
to get your thoughts on it.
Yeah, you'll get my
And,
live take here if I can.
and also all of you in the live chat as we're going through it. I'd like to hear what you guys think too. But I just added this company to my watch list and kind of starting to do some more research into them. And it's mainly commercial properties in California, like Los Angeles, San Diego, I think the Bay Area. And they've started expanding outwards to like Austin, Texas. They have some properties, but it's mostly commercial with some residential. But looks like the properties they're building look really nice. It's got an emphasis on sustainability, and they all just look like really great properties.
Yep. So 4.04%. Yeah, they give them a dividend safety score of 70. $51 a share. Yeah, like you said, West Coast landlord and developer. And I saw Hollywood. Company had 808 resi units in Hollywood and San Diego. which had a quarterly average occupancy of 85% and 37% in San Diego only. That worried me a little bit,
Oof.
but that's interesting that they have residential units. And here, as of September 30th, 2020, so this could be a little bit stale, they were 92% in the office space,
Yeah.
which worries me a little bit, and 95% in life science space. So I'd need to look a little bit more into it at that. And they cut the dividend during the last recession, which is that right here.
Yeah. So back in 2009, they cut
There you
it.
go.
And then
Yep. It
after
was frozen.
2009, it was pretty stagnant for a little bit. Yep.
Yep. Yeah. So yeah, it was stagnant, and then they started growing it again, right? What, 2016-ish? Yeah, $2.08. Their dividend is currently 49% above their 5-year average. And wow, that PE is drastically lower than their 5-year average. So definitely a company that is on sale and undervalued. I would need to, look into it more. So their free cash flow, that's a REIT. You don't look at that. Adjusted funds from operations has been dropping. So that's good that they're seeing that. AFFO per share has been going up. Free cash flow per share, although their sales growth has been down a little bit, but did pop here in the last 12 months. This is interesting. They show nothing the last 12 months of their AFFO, but that has been declining the last. Well, it's understandable though. But heading into the COVID times, they were dropped. They were down -3%, so that's not good. I always say don't worry about shares outstanding growing because they're a REIT, but only 117 million shares. That's not a big company, are they?
No, their
What's
market
their
cap
market
I
cap?
saw was 6
6
billion.
billion. Yeah,
And that
6
could explain
billion.
too the lower FFO per share growth,
Yep.
just because they are issuing more shares. So there is that.
So I always point out, say it's okay for REITs if they're issuing shares because that's how they
Right.
bring in more money to acquire properties. You need to see the sales going up too as well, which it has. And their ROIC, the return on invested capital, has been going up. A couple more metrics. Free cash flow margin, a little bit cyclical, a little bit spotty. Net debt, only 41%, which is not too bad, and not too bad of an ICR. So very interesting, but I would like to see why their free cash flow or their adjusted funds from operation was negative and dipping. I think that's what it was, right? We saw.
No, I think that was the AFFO per share growth.
You're right. You're
Yeah.
right. Yeah, it looks interesting though. I mean, I love it, man. I love it. I actually was thinking about adding more Simon Property Group, but actually we'll see. Since I'm on the subject of REITs, that is the last REIT that I have inside of the bridge portfolio, which is taxable. And if you can, I would like to consider, or I'd like to have you consider, I don't want to tell anyone what to do, but I would say look into or consider holding REITs inside of a tax advantaged account, because the dividends are not qualified, because in order to maintain their tax exempt status, they're more like a pass-through entity. They have to pass through 90% of their earnings in the form of a dividend to be considered a REIT. And I always say they're not paying the taxes, you are. So that's why REIT dividends are not qualified. But if you have them inside of a tax advantage account, you're not paying anything on those dividends anyway, so it doesn't matter. So I'm looking to sell after the first of the year. I'm going to sell my Simon Property Group shares inside of the bridge account and then move that cash over into the Roth and rebuy them in the Roth. So that means I'll never pay taxes ever again. For those of you that are new, the Roth means that you've already paid the taxes on the cash that you're putting into that account, so it can grow tax-free. Whereas the traditional, you are paying that pre-tax, so you have to pay the taxes on that money later. And we won't get in. That's probably too much already. I mean, we don't need to talk about retirement accounts, although I do like to pay attention to it. So let's see. I like this. Cookie Monster said IBM struggled for quite some time. Thinks IBM has made the turn and starting to head in the right direction. Stop by next week and pop on when I talk to EDGI. He probably has some things to say about that.
I saw a comment from EDGI in this live chat, I believe.
Oh, is he on? See, this is the problem with being back like 20 minutes, Here, let me go through these quick. How do you do yours? You don't read every comment, right? You just...
I don't put every comment up there. It just depends.
Yeah, here MU makes memory chips. Thanks for that. Oh, what do we got? Let's see. There he is. All right, there he is. Yeah, it's a big bet on Pat. What should happen to lose faith in him? Yeah. So for those of you that don't know, this is my guy. He is. Well, I don't know how much he wants to divulge. So when we do the, you know, the when we chat, I don't know if we're doing. I guess I should ask him. I don't know if we're doing a live stream. We can, but he will be. He's incognito. He's an anonymous account, so you won't. You'll just see my shiny happy face, and for his, there would just be, it would be blank. But you'd hear his voice. And yeah, dude, it is. I agree. It's a big bet on Pat Gelsinger, and I know a lot of people are losing faith in him. And it's only been a year and a half that he's been at the helm. So I'd like to see a little bit more time, but I do think the Sapphire Rapids is a big miss, and that's not looking too good on him. That's under his control. So let's see. They're too young to know about the bill on Capitol Hill.
Schoolhouse Rock, man.
Oh, Rex. I would contend I'm not. Yes, I know that was the 70s, but I was born in the 70s. I was born in 1978, so I am currently.
Oh, sorry, Russ. I didn't mean to cut you off, man.
Oh, no, I'm just blabbering. Go ahead. You have something important to say, probably.
No, definitely not important. I was just going to say, we used to watch that stuff back in elementary school, and that was early 2000s.
Yeah.
For me.
No, I'm 44 years old, so I do remember it. I know it's from the 70s, I think, early 70s maybe. Or maybe it's the 60s. See, I don't know when it's from, but I know what it is. Yeah, what do you got here? Alexander Kim's. He's been working in data. See, I love this. That's his. Okay, so Alexander Kim, that's a very interesting thing because data center, I think, is more important than the PCs, right? I mean, everything is shifting. And the cloud too, right? Doesn't the cloud have some drag on processors and with everybody not upgrading their PCs and always having to buy a new PC every few years. I mean, the PC I'm using, which actually is Intel inside, Core, I didn't even see that. Core i5. This thing's going on 3 years old. I have no intention of buying another one anytime soon. So that's definitely hurting. But that is really cool, man. That is really cool that you work in there and you know what semis are in demand. Yeah, bad news likely priced in. For now, I think, Nick, that the bad news is priced in until Q4. And then if Q4 is more bad news, look out. I mean, we'll probably see sub $30 a share if we have bad Q4. So, yeah, man, I agree. It's do you know this? What is Dividend Dad's channel, Ryne?
Oh, he doesn't have a channel. He's just someone who watches a lot of our videos. He's an active member of the community, and we were just messaging on Discord, and I don't think he was able to hop on this morning, but he wanted me to tell you what's up.
Yeah, and by the way, look around. Everybody that's in the chat, this is your dividend investing family. This is our community. Right. So
a lot of familiar names, man. It's cool that we have all you guys come out and watch us just talk gibberish.
And we love it too. We love it when you share your information and knowledge because we're limited. We're just amateur investors like you guys. This is our passion and trying to learn. How my Neo option plays going? So slow, but not a lot. I mean, Neo's it's cooled off quite a bit, but I made $19.35, $20. I have to subtract the 65 cents that Schwab charges. So I made $19.35 this week. Low faith in Intel and Meta, and they're doing business together. So, hey, all right, we're almost caught up here. He started a position in Mo. Is the dividend sustainable? High payout ratio, Steven. So you want to give your opinion? I could follow up and tell you what I think about Mo. I know you like Mo, right?
Yeah, I mean, I think for now, the dividend still seems sustainable. There's obviously questions surrounding the longevity of cigarettes and combustibles, but I hope it's sustainable. I mean, the high, from what I've read, and Russ, you might know more on this, the high payout ratio is somewhat by design. Yep. I think, and I could have this part wrong, I think they felt if they didn't pay as much out to shareholders that maybe they'd be more of a target for certain litigation. Do you know what I'm talking about? Is that right?
Yeah, absolutely. So I want to say they target high 70 percentile. Although if anybody knows, I think EDGI might know, but they have most of the tobacco companies do. They have a really high payout ratio. Yeah. And it's sustainable for now. Cigarette, but always say it, you guys know that these are living, breathing entities. They want to survive. They're going to make adjustments. They're going to do what they have to do to survive. And yeah, people aren't smoking combustibles, but that's why they're trying to go to the heat, not burn. And a big ding was their Juul. Yeah, it was Juul, right? Yeah,
Yep.
IQOS. No,
Right.
who owns IQOS? So Juul
Philip
hurt
Morris.
them. Yeah,
Philip Morris owns
IQOS
IQOS.
is Philip Morris, and they had a patent copyright infringement type thing on that they were against Altria on, which is funny because Philip Morris came out of Altria, so now they're more like a serious competitor instead of like healthy competition. I think it's a little worrisome that Altria is 100% in the United States. They're not a global company. So Philip Morris, though, is all over the globe. So they're exposed to, I believe, more people. I know we have a lot of people here in the U.S. But yeah, I think it's sustainable. And let me look. I won't put it on. I know they have a decent safety score, 55, so borderline safe, and their current yield is 8.16%. So they are at a free cash flow payout ratio of 81%. And the last few years, they've been at 81, 77, 79, and 81. So they're pretty much in line. And right now it's just steady Eddie. And I think they're okay for now.
And you know what, too, like kind of expanding on that dividend safety score, I'm sure at least a certain portion of the reason that it's not higher than 55 is because the high payout ratio. So especially when we're talking about a company like this, I think we need to use that context and remember that they normally operate this way. So for this company in particular, it's normal for that high payout ratio. So maybe
Absolutely.
take that score with a grain of salt.
Absolutely. Cody, by the way, Citizen of the Year. He has a Dividend channel, fellow Dividend. It's not fully Dividend. I think you're just investing with an emphasis on dividends. I believe, like ETFs. I think from what I saw. Yeah, interesting. I didn't know that. Reinstated their dividend for the first time in 25 years. So that's probably why it's so low. Much about IIPR. Yeah, they are. We talked about IIPR a good deal last week it was last week or 2 weeks ago with Jeremy from Dividend Stockpile. And they're definitely in a position where they're having some tenants defaulting. They had their top tenant default on their July rent. So that is hurting them. That's scaring a lot of investors, but they are confident that they're going to get through it. Yeah, I think they're okay for the long term, but again, they're also risky. They're also risky. So I want to say go back and listen to last week. I wish I could break these out. It would take forever, like when we talked about something, or the last live stream I did with Dividend Stockpile, Jeremy, we talked about IIPR. I think that was one of our picks. That was one of my picks to invest in. Wheel strategy inside the Roth. Yeah, all the premiums tax free. So what he's talking about, Never Ending Highway, is you sell a cash secured put to get into a stock, and then you get into it and you want to get out again. So you sell a covered call, and you try to do that in between dividend payments if possible to collect even more from those stocks. But yeah, you don't pay anything on the option premium. It's all tax free. So that's probably foreign to a lot of people, and it's something I've been interested in. I love this. Shamir, there you go. He just upgraded from a 5.5-year-old laptop. So that's something that's hurting the semi companies, is that in the PC space, at least, every 5-6 years, maybe people are upgrading. So, all right, look at this. I love it. Came here to support Ryne. So I do appreciate that. Thank you so much.
Yeah, thanks for tuning in. Everyone, really, thank you guys for hanging out with us this morning.
So we'll go an hour, and then I tend to, go a little bit long with these, but I want to save people time. Check out somebody else's check out Ryan's channel. I'm going to watch his newest video too. It just dropped as I was getting ready.
Yeah, you can go watch me buy some Intel.
I love it, man. I love it. So are you getting into options soon?
Probably not. I like the idea of getting into it. And I feel like I get asked this question somewhat often, because it seems like dividend investing and options trading can kind of go hand in hand in a sense. And it's on my radar at some point in the future, but for right now, not so much. I'm happy just going long on all of my holdings and researching companies and just kind of sticking to that for now. If I had more cash that I could maybe set aside to do puts, or if I had companies, if I had more than 100 shares in any other company besides AT&T, maybe I would consider it. But even at that same time, I'm a little bit of afraid to have my shares called away from those companies, because I do want to hold them for a long time. So I don't know. At some point I'll get into it, but not right now.
Yeah, and that's definitely the risk you take, is either getting stuck with something, or like I've kind of experienced with Starbucks. But I will say I also use charting. So I spent a good year and a half trying to be a swing trader, and I took courses. I did a lot of learning how to read charts, like the price movement, which is good for short term, but in the long run, so basically what I'm saying is, with Starbucks is an example, I think it's hit a bit of resistance around like 84, 85, and it should start coming down to the low 80s, high 70s again. I say should, doesn't mean it's going to happen. And the thing is I got paid money, and I'm getting paid money to sell cash secured puts, but I got called away at $82 a share. And I went through it in my last video. I've already received like over $600 of option premium from Starbucks. But if it were to jump up to like $100 a share, all of a sudden, I'm going to miss out on that upside if I don't get in quick. So there's definitely a risk to it. There's nothing risk-free in what we do. And I'll go through these super quick. Is Amazon a good buy? CryptoSonica. I think good companies are always a good buy. It may be a little bit expensive right now, looking at their price to earnings. But do you own any Amazon, Ryne? Outright?
No, man. It doesn't pay a dividend, so you know me. I'm all about the dividends. So
Yeah, so I just threw them on real quick. I mean, they're one of the big companies, and I probably would wait a little bit. I know they just had a huge jump up from their earnings, and that's probably going to start coming back down. I would wait. And yeah, they have a normally higher payout ratio. All right, Steve, let's see. You want to look up NWE and LYB. All right, I'll do it for you, Steve, since he's been. We won't go through them. I'll just give you the safety scores on those. Was it NWE and LYB? Yeah, one of them is LyondellBasell, which I do own. And let's look up NWE. I know it's Northwestern. I don't know anything about Northwestern Corp. 61, dividend safety score of 61. They're a multi-utility company. They do business as Northwestern Energy. So that's a 61 dividend yield of 4.62. So that's pretty high, but it does look safe. And LyondellBasell, yeah, 51, borderline safe. Their yield's 5.56%. And they give them that because they're in the materials sector, which materials and the commodity chemicals can be pretty cyclical. So if there's a downturn in the commodities, then they're likely going to cut. And all right, 57 minutes. Here we go. ASML. Yeah, I don't know. Picks and shovels for me with semis. Yeah, cool. That's ASML. That's one. Here we go, Nick. Mo is 55, payout ratio of 77. Yeah. Here we go. Cody, thank you. Or Hans. I love it. Mo targets 80%. Thank you. I knew it was up there, and I wasn't sure. I wanted to say 80, but I wasn't entirely sure. And let's see. View on Stag. From O to Stag, that's probably good. I think O is a little bit overvalued right now, and Stag, I think, is pretty solid. They have Amazon as one of their tenants, I know, and I think that it was only 3% of their portfolio income. And I know Amazon has been dropping a couple of their warehouse spaces. So if that should happen to Stag, it's not going to affect them too much. So that's kind of one thing we should look at with REITs. And by the way, I'm looking at a book called The Intelligent REIT Investor. A lot of people were talking about it on Twitter. So that I might think is one of my next books. Have you ever heard of that, Ryne?
Mm-mm.
By the way, I just noticed your shirt, the Hellfire Club. Shout out, man.
Been waiting for the last hour for you to say something about this.
I can't believe I didn't notice that thing, man. Yeah, I like Stranger Things. We've chatted a few times about Stranger Things.
I wore this because I was telling my girlfriend, I was like, I guarantee Russ is going to say something because I know he's a Stranger Things guy.
Yeah, I can't believe I didn't. Oh, I was so sad. Just epic, by the way, when Eddie was on just
Oh
playing
yeah.
Master of Puppets. For me, as a metal fan and a kid that just was in high school, I was, probably had a unhealthy obsession with Metallica, especially the old stuff. And I definitely lost some hearing just blasting the whole Master of Puppets album in my '86 Buick Skyhawk, my first car. Nuts. But yeah, so that for me as a metal fan and a Stranger Things fan was just I was hoping Eddie was going to make it, but
I know.
oh Christ, I should have said spoiler alert. So oops.
Oh well.
Well, just pretend I didn't say that, let's see.
This is a really good point. I didn't even think to bring this up when I was kind of talking about it. This is a really good point.
Oh yeah,
I know for me, like, for example, if I was to get assigned some, 100 shares of Starbucks, which is my, it's like one of my favorite companies to invest in, that'd make it like nearly 20% of my overall portfolio, I think. And so I'd love the company, but that's more than I'm comfortable holding.
Yeah, and my strategy right now is so I have the cash. Remember I got $8,200. My initial one was 80, so I've made 200 on that plus the 6. So I've in total, I mean, it's probably like $800 I'm up on. But if they start running up, that's gonna suck. So I really do like Starbucks, and I kind of want to get those shares back. So this week I'm going to miss out on the dividend, going ex-dividend, but I'm going to get $100 or so from the next contract I sell, and I'm probably going to be a little bit more aggressive, which is what happened before to get in around $80. And remember, it was at the low 70s, and I was telling you, like, if I would have waited, but I'm confident in them, and I'm looking forward to their investor day, man. I mean, we both were talking about on one of the live streams with their investor day.
Yeah, it should be coming up next month, like mid-September, I believe.
And they moved it up from December to September. So I think they have some good things to talk about. All right, we're almost caught up. Two more. O has higher dividend growth rate, more years of dividend growth. Absolutely. Stag has only been paying dividends, I believe, for 10 years. So O is a lot more established. But I think Stag has much more upside, but they're going to be riskier. So it's always kind of like that balance of like risk and reward you have to throw off. And Dimitri says he wants to accumulate O, and if there's a downturn that occurs. And I actually lost the O shares because I did a covered call on them at 72.50, I think. And then I had got the cash from that, and then I did a cash secured put on Starbucks, and that's kind of like what started that. So that's that. And Nick's buying REITs. So he's buying store. Warren Buffett buys store. We're all buying store. So, all right, man. Well, that was awesome. I had a good time. I enjoyed it. I love talking dividend stocks. And again, make sure you check out Ryan's channel, subscribe to him, and do all that, all that stuff.
Yeah, well, thank you so much for having me on, man. It's been a while since we've done a video together, but yeah, good to be back in the saddle with you. And if nothing changes, guys, on the next dividend happy hour on my channel on Friday, Russ and I will be joining forces yet again.
Yeah.
To who knows what we're going to talk about? Something about dividend stocks. We'll figure it out, but it'll be a good time. And
I'm gonna have a drink too. I gotta find out what I'm gonna drink.
Absolutely. And guys, if you haven't done so already, don't forget to hit the thumbs up button on this live stream. Let Russ know he's doing a good job here.
I appreciate
it. While we've been chatting, I've created 5, maybe 6 different accounts, and I've just hit the thumbs up button on this video. So that's how much I really enjoy doing this.
That's great. That's great. So, alrighty, everybody, we are going to sign off, and I will talk to all y'all in the next episode.
Yeah, thank you guys for tuning in.
Yeah. Alrighty, we're ending. We're out of here.